Welcome to the Pre-Approval Podcast. My name is Adam Zock. Today with me is Kristin Sevald. She's been in the mortgage banking industry for 16 years. We talk about the three different buckets, the conforming, the non-conforming, and then the non-mortgage. So Kristin is an expert in the conforming, which is always the first spot that people should start going because that is your lowest interest rate, usually your best option. And so today, welcome, Kristin, to the Pre-Approval Podcast. How are you?
Good. Thanks for having me.
All right. So I gave a little qualifier on who this is for and who this is not for, but just to remind everyone, this is for the individual that went into their bank and the bank said no. For those individuals, what do you think are the most common reasons that the bank initially said no?
When typically the biggest reason is credit and what's on their credit report, because most people don't actually know what is reporting on their credit report. They have no idea that maybe there was a medical collection from 6 years ago for $25 that has been accruing interest up to this point because they've maybe moved a couple of times or never got the invoice or never got the statement. So really the biggest thing is looking at to see what is on their credit report that's holding it up, because that's usually the biggest factor as far as, are there derogatory accounts? Do they maybe not have any credit? Do they just not have enough? And so really that's the biggest factor. The second biggest factor would be their overall debt to income.
So on the credit, my goal is, since I'm not a registered mortgage loan originator, not in the banking industry, my goal is on behalf of the listeners to ask really dumb questions because I don't understand it. Because, or ask questions in the fact to help everyone understand. So when someone says, hey, your credit score is low, and understanding your credit, I feel like that kind of gets into this black hole where nobody really understands their own credit. Like, how do you look at past overdue payments versus recent inquiries versus, overall credit usage? Is that something that you recommend an individual tries to learn themselves? Are there other resources that you try to point them towards?
We try to walk through the basics of what's reporting on their credit. For example, anytime someone applies for any type of credit, whether it's a bank loan, car loan, credit card, cell phone inquiries can even be on a credit report. All those credit inquiries stay on your credit report for 120 days. So the more inquiries that you have, the more your score is going to drop. So if you go and apply for a loan at car dealership A, they're going to pull your credit and probably send it to their vendors. Maybe 3 or 4 additional people are going to pull it. You wait a week and you decide, nope, I didn't find a car. I'm going to go into a different car dealership, and they pull your credit. An additional 3 to 4 people are looking at your credit score. So now you have all these additional credit inquiries onto your credit report that are already starting to impact your score. Now, let's say you have a mortgage inquiry or you applied for a department store credit card. All of those stay on your credit. And that's a pretty big factor when looking at overall credit. The other thing on your credit report is, how are you using your credit as far as total utilization? Some people have one credit card and they max it out every month because they only want the one credit card, but then their revolving utilization is high. And so they're just not aware of, that's the second biggest factor as far as impacting their overall credit score.
What is your experience on someone that finds you that says, hey, I have a suboptimal credit score? And for that, I've been, and we'll get into some rapid fire questions here about, some of the criteria of debt to income requirements, down payment, interest rate, and credit score. But maybe if you hammer home on the credit score, how long on average, or maybe a broad range of what does it take for someone to quote unquote fix their credit score? Is that hey, it's going to take a week, a month, a year? And I get that it maybe depends on the situation, but maybe in your experience.
It definitely depends on the situation. If it's, say, somebody that has no credit and they maybe the husband has no credit and they help go onto their wife's credit, wife adds them onto one of her credit cards, credit could be really updated and reflected as far as 1-2 month payments. Once they've been on there for at least like 2 payment cycles. Now, if it's lots of derogatory accounts and no positive accounts, it's going to take a lot longer because you won't be able to get any positive accounts until pretty much all those negative accounts are satisfied. So it really just depends on the level of derogatory accounts that are reporting on the credit report.
Sure. So then the second one that you hit on was debt to income ratio. Maybe just explaining what debt to income ratio is, and then why some individuals find themselves in or above the debt to income ratio.
Yeah, absolutely. So your debt to income is how much money are you making each month versus how many payments are you making per month as far as liabilities. A lot of times, for example, student loans is one of the biggest factors out there. On an FHA loan, we still have to count 1% of the balance as your monthly payment. So somebody that has, credit cards out there or student loans out there, and maybe their student loans are deferred or their student loans are income-based, and have no payment that's actually reporting or no payment that is due, we still have to count a payment against them. And so that's a pretty significant payment. On an FHA loan, it's 1%, and on a conventional loan, it's 0.5%. So that's a pretty big factor when you're looking at overall impacting your debt to income ratios.
Understood. Maybe just from a credibility standpoint, how much have you, Kristin, or have Valley Mortgage done in overall mortgage volumes, let's say this year? I know I didn't prep you on it.
I probably couldn't even give you a number. I mean,
was it 2 or was it more?
As far as 2,
I realize that you're extremely busy and that you have done a lot. And so I just wanted the listeners to know, like, this isn't something that, Kristin's done like, hey, I do, 1 or 2 of these a year. You are cranking out how many of these would you estimate on a given month or day that you're helping individuals get into homes?
As far as like applications each day, probably looking at about 2 applications every single day that we're reviewing as far as 2 brand new applications.
So you guys are extremely busy given this time. A couple of things that you had pointed out was that as we look into, maybe some things that you wanted to talk about or share about with the listeners were some of the historical low rates and some options for first-time home buyers. What are those? Or do you mind speaking to that a little bit?
Yeah, absolutely. So some numbers that I just ran for an individual today, their interest rate of a mortgage that the house they purchased in 2019 was 4.5%. So when we're looking at overall what they're going to pay on their $400,000 mortgage, they're going to pay over $700,000 if they made just their single monthly payment. If they look to refinance, we would be able to drop their rate to under 2.5%. And that makes them, as far as like what interest rate they're going to pay, 2% less than what they're currently paying over that 360 months that they have left. They're going to pay roughly like $568,000 in interest. So a pretty big savings when you look at just 2 percentage points on that large volume loan.
Pretty crazy. How about from first-time home buyers?
So first-time home buyers, there's lots of great programs out there, especially on the North Dakota side. Just because North Dakota gives a little bit more flexibility in their guidelines as far as they're willing to work with a little bit higher debt to income or maybe credit that's a little bit shaky or a little bit newer, and still provide 3% down payment assistance to help them get into that home.
Wonderful. And so just from a clarification standpoint, where are you licensed at?
Valley Mortgage is licensed in North Dakota and Minnesota.
Wonderful. And so all of the context that we have here, although there may be some North Dakota and Minnesota specific references, I would still venture to guess that 95% of it is overall, applies nationally, whether it's FHA conventional to what we're talking about here today. Is that fair to say?
Correct. Yep.
Awesome. As we look at what we are quoting as the ultimate rate sheet. So I have a bunch of rows, and those go from interest rate to down payment to fees to credit score, income requirements, debt to income ratio, and minimum loan amount. And what we're trying to do is have 3 columns where it's the conventional, then the non-conforming, and then the non-mortgage. It just to give you a feel. And so like the example being interest rate, you might get a 2.25% interest rate, or maybe it ranges up to 3 or 4, depending on your credit score on the conventional side. On the non-QM loan, that's maybe 4 to 6% of what you would be getting because it's a little bit different program. And then if you're going non-mortgage, it may be higher than that even still, because there's maybe even more exceptions that you're making to the rules. And so if we go through this, and I realize it's tough, and given tomorrow, everything could change. But do you mind giving a little bit on maybe the range and where you're seeing things hit in regards to some of those categories, and realizing that there's VA where you can get something where it's like 100% loan to value. So there's gonna be this broad range here, and so I'll try my best to qualify these as best I can. But in general, what would you say from an interest rate if somebody was in a qualified mortgage program at what you think they'd be looking at?
On the conventional side, we'd be looking at probably about 2.375%, 2.5%, right around in that range. Also dependent on how much money that they're putting down. Are they putting the full 20% down? Are they putting, maybe a mixture of 5%, 10% down? On the FHA side, the VA and USDA type loans, we're probably looking at about 2.25%, as far as probably 2.25% with no origination fee as well. So, I mean, two on the government side, 2.25% is about the lowest that we've seen, but I mean, historically, it's the lowest I've ever seen on a government loan.
That is incredible. Just saying the word two and then anything after that, I feel like is just bonus if you can do that. Down payment requirements range. I think you alluded to it a little bit. I'm gonna maybe answer this for you. I mean, it could be as simple as 0% down to maybe up to 20% plus, depending on what you're trying to do. Is that fair?
Yep. So there's programs for first-time homebuyers it doesn't matter if it's conventional, FHA, VA, USDA, but on conventional, there is a 3% down. So it can be as little as 3% down. Otherwise, you do pay mortgage insurance until you get to that 20% down. FHA is a minimum of 3.5% down. And then USDA and VA are both 0% down.
Awesome. What kind of fees related to each one can they expect? And the reason I'm asking that is non-QM and then maybe non-mortgage are, maybe their own categories where they have origination fees where it's maybe 1 or 2 or 3%, depending on what you're trying to get into. And on the, prepayment penalty side, there's maybe some things that individuals will stick into there. Can you tell us the differences on a conventional side?
Yep. So as far as like prepayment penalties, we don't offer any loans with prepayment penalties, and most companies on the conforming side are not doing prepayment penalties anymore. A long time ago, they used to be a big deal. Now it's really, I couldn't even give you an example of a bank that is doing a prepayment penalty. As far as the overall fees, it can kind of depend, because a lot of times your rate, if you want the absolute lowest rate, you're probably going to pay a 1% origination, but you can also, maybe you don't have a lot of extra cash on hand. And so maybe you take a little bit higher interest rate to absorb some of that cost up front and then not have that, 1% origination fee.
Sure. Income requirements. This is the biggest variance between the three buckets, where we see most small businesses and self-employed going the non-QM and the non-mortgage because they don't exactly fit into the W-2 box of the conventional style. Can you share a little bit on the income requirements on how you would potentially, whether you fit inside one of those programs or not, what you're looking for?
Yep. So on the self-employment side, we're actually 2 years of filed business tax returns. So if somebody just started their business in 2019 and has only filed their 2019 taxes, unfortunately, they wouldn't qualify. Even though we're at the end, they would have to still file their 2020 taxes to show 2 years of stable income. The other thing with being the self-employed, a lot of times with the advantage of being able to write off a few more items, making sure you're still showing enough income in actual, once you take out all the expenses from the income that you have, making sure that there's enough left over to still qualify you for a mortgage.
Sure. How about for those individuals that are changing jobs? I believe there's something like if you're working in a similar field, it counts. Otherwise, you maybe have to have a certain number of months that you are on a W-2 job. Does that sound about right?
Yep. I mean, there's always going to be an exception to that rule, but if somebody is, a personal banker at Bank A and for some reason now is a personal banker at Bank B, but can explain that the reason that the change was maybe more money or better hours or closer to home, then, if we're going on the conventional side, all we need is their offer letter for their new employment. There's no really waiting period. Ideally on the FHA side, we like to see at least one pay stub before moving, as far as where are they at in job wise. And we also need to see 2 years of job history total on any applicant. So, if they took a year off to travel, unfortunately, that doesn't count. We would need 2 years of employment. If they had 4 years or let's say 2 or 4 years of college experience and 1 year of employment, but their employment is directly tied to what they went to college for, that also would be included in that 2 years.
Wonderful. Next one, you hit it already on some of the debt to income ratios, but what percentage are you generally looking for? Do you know? Like,
Ideally,
is there a fair range?
yep. Ideally, we want to be under 45%, including the new mortgage payment. So we want your all-in payment of what is going to be your new principal, interest, taxes, insurance, all of that, plus the current debts that you have. So if you have a current auto loan, current credit cards, current student loans, we take all of that. And ideally, we want to be under 45%. That's going to guarantee you the better rate, not only in interest rate, but also in your mortgage insurance premium.
And those are the big three: the credit card, the student, and the car. Along with if you had and then factoring in the new mortgage, those are, I would imagine those are probably the biggest four that would count towards the debt for most people.
Correct. Yep. The other thing that might be included in that is if somebody's paying child support or alimony, that would also be included in that number.
Understood. Where can you get a conventional loan? Anywhere?
I mean, anywhere that offers mortgages are going to offer a conventional loan. Some of the bigger places obviously are going to have a little bit more options as far as where's that loan's going to go. If it's a smaller institution, they're going to hold it internally. They probably don't have the same rules and regulations as what a standard conventional mortgage is looking for.
So can you explain the difference a little bit on that? And so from what I'm hearing is, Kristin, so number one, can you explain the difference between just a mortgage lender and maybe a mortgage broker on the differences between the two, if I asked that correctly?
So we are, the nice thing about an institution just like Valley Mortgage, so we have several different mortgage companies that we work with that we can find the best rate for the product that you're looking for the criteria that you meet. So we don't just have one place that we're looking at rates. We're looking at all of the different rates out there for the companies that we utilize here. So really that's, I guess, probably the biggest difference is we're not just looking at one company's rates. We're looking at all the companies that, to get you the best rate out there.
So let's pretend that there are between A to Z, there's 26 different mortgage companies out there. Valley Mortgage may have a relationship with A, B, C, D, J, K, Y, or X, Y, Z. And you're able to pull from all of those, as opposed to if someone just went to mortgage letter K and said, hey, what can you do? And they would have a specific interest rate. And
correct.
So the value of, talking with a broker is that you're shopping around different ones. But then what you alluded to is that there may be, mortgage company S that keeps the loan in-house. What's the difference there between the criteria that you're searching for and if you're trying to meet any Fannie or Freddie Mae guidelines versus what somebody could potentially do in-home or in-house?
Yep. So we follow all Fannie Freddie guidelines and any investor overlays. So, if we're going to, in your same scenario here, let's say Bank B has the lowest interest rate, and so that's where the loan is going. We still follow whatever Fannie Freddie guidelines provides for that specific loan product. So, we're following debt to income, we're filling loan to value, any type of regulations. And then we're also looking at that bank to see, okay, what other additional overlays might they have as far as maybe we need to have reserves, maybe they have additional job time that's required, or maybe they have, you have to own the property for so long. So we're always looking to make sure whatever product they're looking for, they fit into that category.
Sure. So just to break down overlays, because I feel like that is something that maybe is potentially frustrating to home buyers, not really knowing. They're saying, okay, I can Google search what a conventional mortgage requires from a credit score, debt to income ratio, interest rate, all of that fun stuff. And then I go to my bank and they say, well, that's not exactly the same thing. That's the difference in the overlays. Is that what you're saying?
Yeah. Yep. So sometimes there's additional overlays as far as, maybe they want you to own your house for so long before you can take any cash out of it. Or maybe they have restrictions on, you can go up to 50% debt to income, but maybe their overlay is your credit score has to be 720 or higher. So yes, there's still a conventional product out there for you at maybe a 700, but you can't go as big a house as you want if for some reason you don't meet the additional overlays.
Understood. So from a minimum credit score, which is a question we always get asked, and it's maybe a tough question, is there a particular credit score that you're just like, hey, below this, there's really not many conventional places unless you find, a lender in-house that's willing to, bend their own personal rules. But is there kind of a a different lines in the sand as far as credit score thresholds?
With COVID, unfortunately, a lot of lending has tightened up a little bit. So really, we're looking for anybody 640 and higher. Not that 640 and below can't be done, but there's a lot of additional, pieces that would have to fit in or fall into that under 640 credit score.
Understood. We mentioned one thing earlier, which is when some of our personal tenant buyers that we're buying homes for and selling on lease options or contract for deeds, you had mentioned something on, potentially being able, or how they use those rent credits every month to potentially, get them into a home to refinance. Can you elaborate more on if you've helped someone do that and what that potentially looked like? So if someone was, living in a property and then they decided that they wanted to buy it at the end of it, and how you can potentially help.
So it really it depends on how that contract is set up. But if, for example, someone sets a contract that says, as long as you rent for us for 12 months, $100 of every payment you make will give back to you in the form of a credit for closing to help with your down payment or to help with your closing costs. That's absolutely doable. It just, everything has to be well documented. And really, we just follow, so if you have a contract for deed and now we're changing that into, permanent financing, we just follow the letter of what actually is, can you verify that all those payments were made? Can you confirm that, yes, you're actually getting the $100 per month on that
Certainly.
credit?
And so then, as we look at maybe a contract for deed situation where someone's trying to refinance, is it truly looking at a refinance? Can it be a first time home buyer? What's maybe the differences between those?
So it really comes down to, was that contract for deed recorded? So once that contract for deed is recorded, it now shows that who the new owner is on the property. So if I am doing a contract for deed and I purchased the house, my name is now going to show up on the property tax statement as the new owner. If it wasn't recorded, it's going to be whoever the current owner still is. So now if we're basically just going to buy out that and churn it, now it's really truly you're purchasing the property. So then all of the guidelines would still fall into play of first time home buyer.
Is it, in your opinion, is it better to be a first-time home buyer or refinancing?
I mean, you could go either way on that question. A refinance rate is always going to be just about slightly higher than what a purchase is going to be. As far as how long, what is that time frame going to look like? Is this going to be something that, as far as that refinance, is that going to be happening in a year? Is it 2 years? How long will it truly take that person to reestablish their credit where they're able to get to that point? That could also play into that factor.
So let's say someone does a contract for deed on a property that's, worth 100,000 and they put 5% down and then they were amortized on a contract for deed. When you are looking at that property and they're saying, hey, I now want to buy this property it's been 3 years and now their principal payment, started at 95,000 and it's down to 92,000 after 3 years. How do you look at that from maybe a loan to value, or do they still need to come in with a down payment? That would be the standard 5% of the 92,000 to be able to qualify for a new loan.
Well, if they're basically refinancing it, as long as we're under the guidelines for that product. So for example, on a conventional loan, on a refinance, we're looking to be under 95%. So as long as they're under that 95% on a conventional, yes, they might still have to come to closing with some of their closing costs if they don't have enough equity to use the equity in their house. Absolutely. We actually, you can do that at any time. Now, let's say that loan is now at 95% already, then yes, they're going to have to bring all their closing costs to the table to pay. So then there would be some out of pocket on that.
Wonderful. So it appears very well that you know your stuff. So you've been in the industry for 16 years. You've probably seen a lot of different things. One comment was that you had brought up is about in-house underwriters and local decision-making as far as, maybe key things to consider. Do you want to elaborate on that a little bit?
Absolutely. At Valley Mortgage, we do everything right here in our office in Fargo. So the loan is processed, underwritten right here. All decisions are made here in Fargo. So the nice thing about that is sometimes things can happen a little bit quicker. You have a little bit more time to explain situations that maybe are in the gray and we just need to document things. But we have that face-to-face contact where we can say, okay, Mr. Underwriter, here's the situation. So-and-so was laid off due to COVID. So we do have a little bit of a gap in employment, but we're back at the same job as the previous job. And being able to just kind of communicate that a little bit easier and not having to go through email or, sending additional documents. It's all done right here locally and it can be done very quickly.
So the running joke is it's always the underwriter's fault and nobody knows who the underwriter is. Can you elaborate or, that's maybe my experience. Somebody says, oh, we were good to go, but all of a sudden the underwriter said, that this didn't work. Can you elaborate on maybe the difference between, and I'm going to throw around a bunch of words because I don't understand them, is, loan processor versus loan originator versus underwriting. Can you elaborate on the differences and why someone should care?
Absolutely. So I am a licensed loan originator. So I'm the one that actually takes the loan. I gather all the documentation up front. What the processor's job is they're going to basically process the information. So they're going to verify the employment information. They're going to verify the assets. They're going to make sure that we've got title work and that it has the right legal description. They're going to verify that the appraisal matches up and that the value. They're going to make sure we have homeowners insurance. So they're basically putting everything into the basket once they, gathering all the exact details. What the underwriter is going to do is they're going to make sure that all those items in that basket actually match the guidelines of Fannie and Freddie and that investor overlay to make sure that, we only need one pay stub. We got it. We need, 2 bank statements. We've got 2 bank statements. They're both corrected, dated in the correct date. So really it's kind of a checks and balance, if you will, making sure that what information did I gather? If I missed something, what did my processor get the rest of it? Making sure that we have no gap. Maybe I had a pay stub, but now it's expired because of COVID. Everything has to be dated within 30 days. So now we have to get updated pay stubs. That's going to be where your processor is making sure that those dates are correct before sending everything into underwriting.
Can you explain the process a little bit between the loan officer, the processor, and the underwriter on, let's say we get under contract January 1 and we're hoping to close February 15th? Can you talk through, who is reviewing what, how it works through before it's like, hey, you're initially pre-approved versus, hey, this looks like it's a go, to, hey, this is fully being funded and that this is going through. And the only reason I asked that is we've personally stepped in, not for anyone through Valley Mortgage, but for other lenders where all of a sudden the underwriter said it's 5 days beforehand. And guess what? Either the homeowner screwed up and pulled out a different line of credit, or the underwriter found something that, should have been caught maybe a little bit earlier. And all of a sudden they can't close on the home. So can you talk through the timeline a little bit on when it's kind of like, this is 25% chance of going through, 50% chance. Okay, now everything's 100%. This thing's closing.
That's kind of a difficult question to give like exact details. So as far as like the process with me, when someone takes an application, I'm going to ask for their credit report, or their tax returns and their pay stubs right up front, because I want to know what we're looking at, and you can kind of gauge where, as far as like income. Okay, was there a gap in employment and that's why they've got 3 W-2s? You can kind of gather that information before you even give the pre-approval process. You can see what their debt to income is. You can see what their income is going to be. You can calculate what the mortgage payment is going to be on the house and kind of see that full picture. Now, things that could change, obviously, once the process is going through, there could be something that shows up on title, which is something that wouldn't be known up front. So when the title and the underwriter is looking at title and there's 2 liens against it, is it a lien against the property? Is it a lien against the person? Is it just a name match? Maybe there's 2 John Smiths out there, and John Smith A has a tax collection from 2020, and now I can't get this house because the name match. It's all of verifying those different things as far as kind of timeline. How quickly are the files getting underwritten to find out when are those situations being uncovered. Understood.
You had mentioned one other cool thing called the Homes for Hero program. What is that?
So our Homes for Heroes program is at Valley Mortgage, we give $500 off of their closing costs on any purchases for all the heroes in our community. So police officers, fire department, EMTs, nurses, doctors, anybody that's out there that's really serving the community.
That is fantastic. Those were all the questions that I had. Anything else that you wanted to add that we maybe didn't cover here on the pre-approval podcast?
I think that's everything.
Well, thank you very much. You've been a wonderful guest. And if someone wants to get in contact with you, Kristin, I'm going to have some of your links in the show notes below. But just for those maybe listening, in their car or as they're working, what is the best way to get in contact with you?
Yep. So they can give me a call on my cell phone, 701-371-7723, or they can go to our website and apply at valleymortgageinc.com.
Giving out personal cell phone online, that's how you know you're committed. So I have personally used Kristin. I can vouch for her. She actually bought our home, which is why I wanted to have her here as, one of the first guests on this show. So thank you very much and hope everyone is having a good day.
Thank you.